My guest today is Jon Lerner, the co-founder CEO of CoinTracker. CoinTracker is a market leader in portfolio tracking for tax compliances in cryptocurrency. Jon and CoinTracker have gone through Y Combinator. The company has raised about $101 million at a $1.3 billion valuation. So they're well on their way. We talked about tax policy in the US, how it's shaped today, the spectrum of whether governments are lax or whether they're aggressive, where they are today, where other countries are, how crypto is classified, things you should be aware of if you're trading in crypto, tax implications, all sorts of things. If you're trading crypto, you need to listen to this conversation to be aware of what's happening and what you're liable for, because you do have to pay taxes if you trade cryptocurrency. We talked about the direction of the country as it pertains to regulatory decisions that were made in the last few years and what could come down in the future. And lastly, Jon gave a few recommendations on books and people he follows that have really influenced his thinking and company building. So hope you enjoy this conversation. Here is Jon Lerner, co-founder, CEO of CoinTracker. All right, Jon. I'm excited to chat with you today. I love what you're building at CoinTracker. Why don't we start there? Can you tell me, I'm curious, what was it in the early days? What problem did you see in the market that you wanted to solve, and kind of how do you describe where things are today?
Cool. Thanks for having me, Mike. Yeah, so this, I guess, taking us back to 2017, both myself and my co-founder, Chandan, were early crypto users at the time. We were using a few different exchanges and wallets, kind of playing around with the fringes of crypto at the time, smart contracts, various use cases in DeFi, and quickly ran into the pain point ourselves of once you're using crypto beyond a single exchange, you really need that product in the middle that's able to give you an aggregate view of your portfolio, all your transactions, your market value, your ROI over time, all of that stuff. And so we hit these pain points ourselves, and we talked to other crypto friends of ours and realized this is actually a major problem in the space. And so we set out to build that. Fast forward to today, CoinTracker, what it does is it enables crypto users to connect all of their exchanges and wallets. We automatically process all of their data and transactions from all these different places and seamlessly present them an aggregated view of their portfolio and taxes. And that last piece especially is important. As you're probably aware, crypto is viewed as property in the eyes of the IRS and other tax bodies in the world. And that means every time you transact with crypto, there are tax implications on it. And without software like CoinTracker, it would be almost infeasible to be able to track that accurately and report your taxes correctly. So these are the core pain points that we have been solving for.
And what is technically speaking, what are the data feeds that you have built out that maybe would be able to track transactions from different wallets? Or can you describe like what you have access to, what you wouldn't have access to, and how that works?
Yeah, there are a few aspects here. One aspect is exchanges that users use. With most exchanges, we offer basically the ability to connect that exchange, and through their API, we're able to synchronize all of their transactions and balances and basically input it into the product. Then there are different chains that people transact on. They may have hardware wallets, they may have software wallets, they may just have an address on the chain like the Ethereum and so forth. And so with those, again, we enable users to just add those public addresses or wallets to CoinTracker. It's on a read-only basis, so they're not actually giving us any write permissions on anything. And we're able to either look directly at the nodes and the blockchains to synchronize those transactions and balances, or use a high quality API that we trust to, again, make all of that seamless and kind of feed it into CoinTracker on an ongoing real-time basis.
And is the AP, you said the API you trust, is that, are those APIs, if there's multiple, are they APIs coming from the wallets if they provide those?
There are APIs that are built with the data that's coming directly from the blockchains. So if we're using sort of a third-party API, they're likely running nodes of their own, like a Bitcoin node, an Ethereum node, and then aggregating all the transaction information so that we're able to look up a public address and get all the transactions for that public address, get it back into a coin tracker.
Gotcha. And so foundationally, people being able to track all the different transactions that they have would be relevant for tax purposes because tell me if I'm saying this correctly, but every transaction you make between every different currency, cryptocurrency, is considered a taxable event in the gain or loss relative to the US dollar that you're making on that event at that time.
Yeah, that's spot on. Every transaction that takes place in crypto, if you're trading one crypto to another, like a Bitcoin to Ethereum, or if you're selling a cryptocurrency to your fiat, like let's say you're selling Bitcoin, getting US dollars out of it, both of those scenarios are a taxable transaction and will have a capital gain or capital loss. And what makes this actually more complicated is that in order to determine that capital gain or loss, you really need to have every single transaction you've ever done in crypto across all your wallets and exchanges reconciled in one place so that you correctly follow that chain of events that led up to that transaction and then you accurately compute that capital gain or loss in every transaction.
And you need the history because you need to know what your initial USD basis was, what you came into crypto with. Is that right?
That's correct. Yeah, that's right.
Wow, that sounds daunting. Do you feel that the regulation is settled here? Is this the way that is there a lot of tension either from politicians or from the crypto universe pushing to change this? Do you feel like this is solid state regulatory policy, or do you think this will change to some other method of accounting?
There's definitely a lot of ambiguity and unresolved questions in the crypto tax code per se. But whether it's treated as property or not, meaning there's going to be capital gains or losses on it, isn't actually one of the main topics of consideration. At this point, it's quite unlikely that that will change. I think there will be lots of changes and hopefully clarifications over time. How things like airdrops are taxed, how forks are taxed. If a coin loses all its value, can you use that as a tax credit? Questions like that. But to the question of whether it's property or not, that's going to be very unlikely that, especially in a country like the US, will change. It's actually something that IRS and other tax bodies sees as a sort of one of the primary future sources of sort of revenue. And that's going to be unlikely to change, which means that there needs to be a lot of automation in the space. That's one of the roles that we're playing here is people that are using cryptocurrency, they really want to be tax compliant. It's just a huge hurdle and there's a lot of ambiguity. And so the role we're playing is making it as easy as possible for you to use crypto as you want to. And then throughout the year, having visibility into taxes, if possible, actually optimizing some of those taxes. And at the end of the year, having a simple experience where it's a single button click and you can take your reports, put them into the tax filing software or give it to your accountant and be done with that problem and have the peace of mind that you did it correctly. Yeah, it is very complicated, but with technology, I think it's also something that we can solve. And further, we can do it in a way that's actually, in many cases, favorable to the consumer.
Right, right. So the consumer would put in the different wallets they have. So maybe they have four different Bitcoin wallets on four different devices and places. They have Ethereum, they have Bitcoin Cash, whatever they have. As long as they give CoinTracker those wallets, then you'd then be able to see the entire history. You'd be able to say this is what 2020 taxes are, 2021, because you know start and stop times for transactions. Is that Does it get more complicated than that? Are there some cases where you just can't, uh, not you, but CoinTracker wouldn't be able to generate reports for people, like if they're in the Monero, Zcash, untraceable world? If like, what are the things where you're like, this wouldn't be traceable, trackable?
Yeah, that is right. Our job basically is once you're adding those exchanges and wallets, we need to synchronize not just what you have there right now and in the future, but what you have done since day zero of your crypto journey. Um, there are definitely a lot of complications with whether it's with some chains, with some exchanges. For example, there are exchanges that no longer exist. There's no API there. Um, you may have some very sort of um, poor data, like a CSV spreadsheet from back in the day. So in those types of cases, our job is still to make it as easy as possible for you to be able to input some kind of data into the software, and and whether it's automatically or with a little bit of like kind of a smooth user experience with the product, enabling users to correctly get those transactions added, maybe in some cases reviewed a little bit more manually, corrected if there's any corrections to be made. And our job at CoinTracker is to kind of at least flag what doesn't really look right, give you the user experience to correct those things, and hopefully get it to a fully reconciled state. But as much as possible, we invest very heavily into the core technology where we get as much of this right out of the box as possible, and then have the right kind of visibility into anything that doesn't quite look right so that the user can be aware of it and hopefully take action on it to get it right.
Hmm. What are your thoughts today on like enforcement? I know there's got to be a spectrum of people that have different, what would you call it, susceptibilities to, or they're inclined to be more risk averse or not risk averse, and they would say, oh, let me try to move some wallets here. Maybe they're moving another country. Maybe the line is gray in some way. Is the government, say maybe take the U.S. government explicitly? Do you feel like they're kind of in this state of let's figure it out, let's not be over aggressive in prosecuting people, or are they on the other side heavily trying to collect what they feel is right, heavily investing in tax collection technology, that kind of thing? Like, where are we in the on the
Yeah.
spectrum of enforcement today?
I would say we're probably somewhere in the middle, but it's
Mm-hmm.
increasing in sort of scrutiny and level of investment on the US government side every year. Um, I think it's very clear that the US government recognizes that cryptocurrency is a really important aspect of tax collection, and of making sure people are compliant. Um, and we have definitely seen over the years a lot of letters go out, audits happen, especially with higher net worth individuals. There have been cases where they have gone to some of the centralized exchanges to either subpoena or request more information on certain users. So we definitely have seen a lot of that happening and increasing um, every year. I think crypto as a technology will present sort of avenues for people to kind of take some of their wealth and have it outside of the visibility of the government they're in. I think I think that the government will invest into that for the higher net worth individuals. Um, and in our case, we tend to be aligned to kind of the user first and foremost. So our job is to give them the tooling they need to kind of take the responsibility of adding all their wallets and exchanges and being able to get those accurate tax reports based on what they've added. But even ourselves, we have no way to know that there isn't something else. And so the responsibility of adding all those things in order for accurate taxes to be kind of output to the user and eventually to the IRS is still falls on the user themselves.
Yeah. And do you have any kind of, or have you talked about, if you haven't launched anything, that any sort? I think I remember this on, it wasn't QuickBooks. What's the tax filing software? That's
TurboTax?
really TurboTax. Yeah, I think they. Tell me if this is right. Would there be an option to say, do you want to be more conservative, more risk taking with your reporting, in the sense that there are undeniably sometimes gray areas when people report taxes. You know, maybe this is another, you mentioned airdrops and a few other examples. I'm thinking there is recently a few crashes, a few accounts like Celsius and others that have been wiped out. There's countless examples of hacks and rug pulls and things. Are these, if something is quote unquote lost or hacked, nothing's permanent. I mean, who knows what can happen in the future? Can people report losses? Do you feel like there's a lot of ambiguity around reporting to a large degree, or do you feel like it's pretty much simple to understand for the majority of cases?
I would say that a lot of the bigger questions have now been clarified over the past few years. So there
Mm-hmm.
was, for example, a few years ago, um, let me back up a bit. When you're calculating these taxes, as we talked about, and are following that chain of kind of events that happen to get to the capital gains or losses, the cost basis method that you use is a pretty significant factor on what the taxes will actually look like. So, for example, if you use something like first in, first out, you might get a certain tax result. But if you perhaps use something like highest in, first out, you will get, in most cases, a more favorable tax result. So, in the last few years, the IRS has actually clarified their position on something like this to indicate that as long as you have good record keeping of all of your transactions, you're able to actually apply something called unique identification, where any sell of any asset can be attributed to any arbitrary um, previous purchase of that asset, as long as you're maintaining those records and are not doing things like double dipping, like the actual accounting of it is all accurate at the end of the day. And so, again, with CoinTracker, since that change, we have actually applied, more favorable treatment of your taxes as the default option for users. And I think that's one of the sort of top factors that influence the tax result. On the other hand, so that's kind of the big thing. There are other sort of areas of ambiguity, like we talked about. If something like a coin goes to zero, can you write off like loss that as a loss or not? That still remains to be kind of addressed, and we tend to take a slightly more conservative approach, but perhaps have some content out there or even a toggle in our setting that lets users who are savvy enough and are comfortable enough take that alternative view and process their transactions that way.
Yeah, interesting. Um, I'm split between which way I want to take this. There's two things I want to ask you. Let's go with this one first. So I have a note here. Senator Cynthia Loomis and Kristen Gillibrand proposed the Responsible Financial Innovation Act recently. How is that impacting, and how do you think it will continue to impact the crypto industry?
I mean, I think overall,
And can you,
it's a
sorry, can you
pot.
explain a little bit what it is, what the law, the act pertains to?
Yeah, actually, to be honest, I don't have full clarity on that off the top of my head.
Mm-hmm.
But I would say the general trajectory of starting to address some of these key questions in the space, um, especially around crypto taxation, but of course around the entire sort of regulatory landscape of crypto, like what are exchanges responsible for reporting to the government? What are protocol developers able to or not able to do? How does the securities laws work? How do they need to evolve? I think those are all areas that are going to be really important to get clarity on in order to continue to drive innovation, comfort to for that innovation to take place in the U.S., not abroad or somewhere else. Um, and so I think we tend to, champion that progress, and especially on the crypto tax sort of side of regulations, um, try to take kind of an educational approach to working with the IRS, giving them the understanding of like how does cryptocurrency actually work, what might make sense from the standpoint of some of these tax questions, what are users struggling with, how can we actually maybe make it easier for users to comply, which I think both obviously the IRS wants and users want. Um, and so, yeah, that's kind of, it's still, I would say, pretty early on. I think the IRS is, and the government, generally speaking, is still in the early phases of really understanding this new technology. But the fact that they are embracing it and showing positive signs of not hindering adoption or innovation is a really great sign and signal for entrepreneurs and startups that are trying to innovate in this arena.
Mm. I've heard people say that, and it makes perfect sense, that because the blockchain is inherently public, that it gives the government almost their ideal situation to see how money is moving around. The flip side of that is you have to tie a wallet address to a human being, which can be the challenging part, unlike, say, a bank where that's directly connected. Do you feel that people, I think crypto presents a lot of it invites a lot of idealists to a future of societal organization through currency movement. I don't have to tell you this, or certainly anyone listening, but there's a huge excitement in crypto behind the philosophy and the idealistic improvement to the way that we operate as a species, as a society, as a country in particular. Is there a strong resistance to people wanting to pay taxes? I mean, there always is, but in crypto, I would imagine there's ways you can sort of convince yourself, hey, I'm in another world. This is like, they're not going to come after me. They're not going to connect to my wallet. And I would imagine this is represented in the percentage of people who are actually paying taxes for crypto gains at all. Do you think this is a small fringe minority of people who have this mentality that are really not, I wouldn't say intentionally trying to evade taxes, but they sort of think of it as something entirely different from the US dollar, fiat currency, banking, Web 2 world? There's a distinct psychological separation in people's minds between these two worlds, and to then go and cash out my crypto and pay taxes in the US dollars, it's a heavy weight. I'm not arguing. Certainly, I think there needs to be a mechanism for centralizing resources so that we have roads and firefighters and those kind of things, and we have to live in a physical place, so it makes sense. But it seems like it's becoming more detached from people are more detached from the actual value that they're receiving from government, and that creates a kind of resistance to it. Is that something you're seeing in the numbers, maybe percentage of people who are paying taxes, who want to pay taxes properly, who are feeling conservatively minded? I imagine this skews with age to some degree, or accumulated savings. The more you have, the more you want to protect. But are there other things that you've seen along this line?
Yeah, it's a pretty big question, especially on
Yeah.
the are people responsible for paying taxes in the future. And I mean, I think at the end of the day, death and taxes, as they say, are the two things that are not
Unavoidable.
avoidable. But I would say that there's probably two dimensions here. I think in terms of people who are kind of philosophically choosing, they shouldn't be owing taxes to their government, and are just not going to comply. I would say that's probably a pretty small, perhaps vocal minority. Generally speaking, there are always going to be folks like that, um, but in any, whether it's crypto or outside of crypto. But I would say it's more of a minority. I do think that um, the other sort of dimension to this is just where we are in the adoption life cycle of crypto, and especially on actually complying with crypto taxes. I think it's still pretty nascent. There's still ambiguity in the tax code. So I think a lot of folks in the space either don't actually realize that there are tax implications of using crypto, and are just kind of not aware of that problem, or are maybe viewing it as a bit of a grace period right now until kind of the governments get their stuff together and provide full clarity. Maybe there's a bit of a grace period. I guess the issue with that is that once that grace period is over and people actually get audited, penalized, the governments will be able to look back at not just the past year, but at your history of using cryptocurrency. Um, and so the amount of fees and negative implications of that scenario could be drastic. And so I think it's prudent, for us and for the industry as a whole to kind of drive that education awareness of taxes and avoid that negative sort of scenario where a lot of people are suddenly, penalized and potentially lose confidence in the space. So I think it's actually something that we worry about a little bit. I think realistically speaking, we think that probably less than 25-30% of users, crypto users, even in the US, where it's probably most advanced in terms of compliance, are actually calculating and filing their capital gains and losses on crypto.
Wow.
But
Yeah.
yeah,
So
it's
sorry,
still
less
pretty
than
early.
30, less than 30% calculate and file taxes in the US.
Yeah, this is a little bit anecdotal. Like we don't have clear
Totally.
evidence of that, but I think it's still a minority of users that are both aware and are actually able to comply with crypto taxes. And so I think, yeah, there's a little bit of a delay factor of like adoption happening and then people actually complying with taxes that um, will likely change. I think probably the inflection point is going to be um, probably in a few years, 2025 or so. In last year, when the infrastructure bill passed in the US, a provision there was that every centralized exchange is going to have to file these forms, Form 1099s, on behalf of every user they have, reporting to the government all the transactions that they took in that exchange. Um, now, it's not going to necessarily provide a full picture of their tax obligations to the government, but it will provide a signal to these systems that they're likely going to build in order to try to find, people who are not complying. If you have a lot of transactions on an exchange, but your filing doesn't show it, it's likely that that person might be targeted with an audit, and then potentially penalized. So that's a key example of something that the government is doing to be able to take what they've been able to do in the non-crypto world with brokerages and at least have that key input to their systems in the coming few years.
Hmm. It's fascinating. I would have guessed more people at this point were paying. Some of them seem pretty straightforward. Like if you come in with $1,000 of USD, you trade a bunch, and then you were to cash out. Well, if you cashed out with 2,000, it seems that people would think that you'd have that gain. Maybe there's this confusion with, hey, if I'm in crypto, whatever I'm gaining is not being realized until I'm cashing out at USD. That typically that's how when I talk to people, that's how I'm sensing that the
Mm-hmm.
mechanism for taxation works, is that it's what you come in with and what you leave with. But if it's tracked on every individual transaction between currencies, it's like that's a big overhead. What do you think? Do you think there should be or could be any way that the government were to create something or restructure the tax code. Certainly they're coming into crypto with an existing mental model for taxation. Do you see something that is that like integrates well with the crypto community and people would be excited to embrace it? Because, you know, as citizens, we want to have these public services. You know, we want to have roads that are drivable and police that come when you call them, and et cetera. How do you sort of think it it can go? Because I sense a growing resistance, particularly from the US dollar to like the Bitcoin world, where there's, you know, it's kind of like, is that going to become the major tension point for our society? Balaji is a, you know, popular podcaster, writer, and wrote a recent book on this, which I read, which was fascinating. And he kind of realigned the tension point between like left and right to Bitcoin versus BTC versus USD, which I found fascinating because that seems like there'd be enough people on either side to really cause a strong, you know, strong resistance. I'm curious if you make sense of that, if that resonates with how you sort of can see the trajectory of the world going as it pertains to crypto versus fiat world.
Yeah. I would say like I think the tension of taxes is always going to be there.
Mm-hmm.
It's one of your biggest expenses in your life, and so it's kind of inevitable. I do think that you know, especially in today's day and age, like people have the ability to take their belongings and go somewhere else. And I think in a way, cryptocurrency actually lowers the barrier of doing that because now you have this, you know, this store of value that's in many ways superior as sound money from fiat. People potentially, especially the types of people we're talking about here, have more confidence in the long term future of that as the store of value. And so the fact that that exists actually lowers the barrier for someone to pick up their stuff and go somewhere else where they believe in the way that the tax code works in that jurisdiction, and are able to kind of choose and decide what's best for them. Um, and so to me, that's one of the great things about cryptocurrency is it provides more equal access. It kind of reduces the barrier for someone to be able to decide what they want, how they want to live. Um, um, and if they're not happy with the tax code in the US and they prefer sort of in the grand scheme of things, the trade-offs that they would have living somewhere like somewhere else, whether it's Singapore or where have you, um, then they're certainly able to do that.
Mm.
Yeah, in terms of in the US itself, I think there could be a kind of this tension that gets created from people who are believers in Bitcoin, cryptocurrency, and just don't believe in taxes. But my sense is that, you know, the country and the government has, you know, enough control, at least in today's age, like to kind of take action on that. And so I'm not sure that that's a viable path for people that will, you know, set them up for a great quality of life.
Yeah, yeah, I agree. If you're going to talk about taxes, I think it's hard to see a world where people think that they shouldn't pay any taxes into a collective pot and that work. Like the percentage of people who are like, you know, massive Bitcoin supporters, crypto supporters, I bet it's relatively small if you actually talk to them who said, do you think we should, you know, take a percentage of what we make in a year and put it into a pot and reallocate resources collectively? There's certainly some people who are like complete anarchists and complete libertarians, but for the majority of people, you can just make the example of like, what if your house catches on fire? Don't you want somebody to come with a fire truck and
Mm-hmm.
put it out? Like there's some examples that are just hard to deny. You know, there's fringe cases like, okay, healthcare, you can make an argument. Is it better served publicly or privately or some combination? But some just, you know, roads, they just make more sense to have collectively. So I think the majority of people who are even on BTC side would be in favor of at least some taxation mechanism. the extent to which it's happening today is probably the degree of which taxation is happening is probably the friction point that causes a lot of attention. What other countries? Let me first ask you this: is CoinTracker only U.S. focused, and if so, is it on the horizon to move into other countries?
We're actually we are currently available. Our tax functionality is currently available in 4 countries, or actually 5 countries: U.S., Canada, UK, Australia, and India. And really, our ambition is to offer the value we're offering in as many countries as possible. Um, and so, I think this is the way that crypto is taxed in the U.S. is similar to the way it's taxed in most major countries around the world. Um, and so there's a clear need, clear demand. I think they may be a little bit sort of um, more nascent in terms of that kind of compliance rates, and do people actually file their crypto taxes? It's probably a little bit behind where we are in the US and a few of these other countries. But nevertheless, we want to be able to offer it as globally as possible. Um, I would also say that our portfolio tracking functionality, which is what lets you have an aggregated view on an ongoing basis of your portfolio, is actually available globally. That's easy for us to provide anywhere, and so in any country, people can get it and use it on an ongoing basis.
Mm. Have you seen any countries take a orthogonal approach to taxes and doing something pronounced and different, or is it basically all the same everywhere?
There are definitely some exceptions. For example, up until recently in South Korea, um, they actually explicitly said that they're not going to be. Um, it is treated as property, but they're not going to be collecting capital gains losses on crypto activity. Now, this has changed recently, and they've now said that that's no longer going to be the case. But that is one example of that. I believe in Japan as well. It is not. It's actually currently treated as currency, um, and so there is no capital gains and losses on it. Again, not sure if that will necessarily stay that way forever, but that was their position in the past decade there as well. And then, of course, there's places like El Salvador where it's you know also treated as currency, and some sort of a minority of countries like that. But otherwise, most of the major countries around the world are treating as a capital asset.
And whether it's treated as a currency or property, kind of from a high level, is it obvious how taxation differs between those two? And are the different currencies that are out there need to be individually assessed for certain properties to determine whether they're categorically not cryptocurrency or property?
Within a given country, like if it is treated as property, then the general sort of framework is pretty similar across the board. Of you need to be tracking sort of that chain of events to be able to compute capital gains or losses. But there are, of course, very specific sort of rules, taxation rules in every country that may differ from one to another. Um, UK comes to mind as an example. There are some pretty interesting kind of 30-day look ahead rules where if you dispose an asset and then buy it again, you may have it may change kind of the historical gains and losses as well, which we don't have in the US. There's questions like, is there a wash sale rule or not? So there are these nuances in every country that apply to crypto as well. In many cases, there are gray areas too, where it's not explicitly defined how something in crypto should actually work. And so that is something that we as a company and product navigate and kind of productize it into the experience itself.
By navigate and productize, do you mean that would give some kind of opinion as, hey, we think this is probably a currency or probably a property based on these attributes? Is that the kind of thing that you'd put out there?
Yeah, that's right. We would take a position on, like, we think this is the best, this is the most sort of the most correct way to treat taxes in the given country. We would kind of talk to experts, to accountants in the given um, country. We would kind of put that into our backend systems, into our algorithms, and we would expose those kind of that information to the user, to the consumers themselves, and that would kind of dictate the way the taxes are calculated in that particular country on CoinTracker.
Yeah, yeah. And what's the major difference between the two, between a currency and a property? If I traded a bunch of Bitcoin and I gained more than I lost in the last year, if it's categorized as a property versus categorized as a currency, what are the differences? Because in the word cryptocurrency is currency. So intuitively, I would imagine people are thinking of these things as currency. They look like currencies, they act like currencies. What's the deal? Like why are we even talking about property?
Yeah, the deal is that they have totally different implications. I think that probably the easiest way to think of it is an example of a currency is, let's say you got let's say you got British pounds and you're using them in the US to transact. Um, there's no tax implication unless you go to like a certain very large value where you're kind of trading US dollars to British pounds um, and back. You're not going to have any tax implications on that conversion. And as you transact, there's no, basically it's not going to show up in your taxes at all. On the other hand, um, if when you buy and sell a house, um, you buy it at a certain price, you sell it, let's say, at a higher price. That the difference between the price you bought and the price you sold is going to be your capital gain, and it's going to have a certain tax rate depending on which state and country you're in. But unlike a house where it's happening like once every few years, maybe, um, or unlike equity, like kind of stocks and equities you might trade, which are happening only on a single brokerage and you're only using it as an investment. In crypto, you're using this capital asset, this property, to have it as a store of value, transfer it between different wallets and exchanges, pay for goods and services, transact in DeFi, buy and sell NFTs. So it's happening on like potentially a daily basis, and across many different places. And that's where the capital gain and loss implication really comes into play. So you might, if you're a very active crypto user, and you're not paying attention and you're transacting sort of in sort of at a certain level of money, at the end of the year you might have a large tax bill that you may not have been expecting throughout the year, and that's really the implication of crypto being treated as property rather than as currency.
In everything you just described there, when you're moving it around, you're buying an NFT with it, that sounds to me like a currency. Now, I use a currency to buy things. I don't really use property to buy other property. It's kind of a barter system, which is not, you wouldn't, I don't think anyone thinks of Bitcoin as a barter system. Like I'll trade you this water bottle for your painting on the wall. Do you think is it correctly defined? I mean, do you see if does it make sense to you personally that it's in the property category, or do you think it should be reconsidered in currency or some other category entirely?
So to me personally, I think the easier and simpler we can make this for consumers, the
Mm.
less hurdles there are to massive adoption of crypto. And we may not benefit from that as a company and product, but if you take a long term view on this, I think it's important for adoption for crypto and for the world more broadly. And so I think insofar as we can simplify this, I'm a big proponent of doing that. the unfortunate thing though is that it's unlikely that that particular question will change in the U.S. and many other countries. Um, and so I think it's just unfortunately not realistic. There are potentially things that we could do to make it a little bit easier. For example, having a de minimis exception where below a certain threshold, not every transaction gets taxed. And it's actually something that we would be in favor of having in the space if possible. But kind of TBD to see if the government is open to that direction or not.
I would imagine their incentive is, hey, we'd rather have it be simple because we're more likely to receive tax from people if it's
Mm-hmm.
simple. I mean, if it gets too complicated and too hard, people kind of, if a majority of people throw their hands up, well, then the IRS just has this impossible task of trying to track down millions of people. And there's a certain level of people that you can enforce if they're knowingly evading taxes. But if it's so confusing and so hard that people practically, with good intentions, just kind of don't know what to do, so don't do anything, then yeah, I would see that as a conflict of interest for the government. So an example of the de minimis level would be something like, I know on Uber, Airbnb, TaskRabbit, these marketplaces, if you earn under, I think $600 as a 1099 contractor, then you don't have to report that to the government, or maybe that you do, but the government, or sorry, the marketplace wouldn't have to report that to the government. That would be the kind of thing you're talking about. Is that about the value increase? Do you think it's like a 10,000 or under, or 1,000 or under level for
It's
the de
probably
minimis?
less, yeah. Yeah, I think that's an example of a policy that could simplify the sort of the tax code for using cryptocurrency in the US. I think it would likely start at probably much lower than $1,000, um, and yes, as I said, like TBD if that actually passes or not. I think that would be a positive thing for simplifying, using cryptocurrency as you mentioned, um, and yeah, I think that's a
Mm.
way that, within the boundaries of it being treated as property, which I think is unlikely to change, we can still, increase simplicity and feasibility of using it.
Mm. Are there specific leverage points that the government tends to use, or would you'd expect them to use to evaluate somebody who's worth pursuing from their perspective? If you, for instance, a couple of things come to mind, but tell me what else you see. I would imagine if you paid a lot in taxes last year, paid nothing this year, that probably caused a concern. I know a friend of mine believes strongly that if you report taxes with round numbers, like, oh, I made $3,000 and 00 cents, that tends to throw a flag. Are there, maybe if you sent money, an ACH or wire transfer from your bank to an exchange for some amount, 10,000 or more, some trigger amount, that caused an exchange, causes a flag if you don't report anything. You sent US dollar to a crypto exchange and nothing ever happened. Is this the right way to think about it? Does the government have other obvious? I mean, a lot of this is speculation, right? They're not going to be public with this, I realize, but does anything come to mind of like leverage points, areas that would maybe obviously trigger a concern on their end?
Yeah. I mean, I'd be curious as well to understand sort of how these systems work on their side, like whether it's how sophisticated it is. Is it like machine learning algorithms that are picking up all these inputs, training on past data, and kind of intelligently assessing this for a new space like crypto or not? I don't know sort of what the case actually is, but I think thinking through this, I think first is which destinations are they going to have visibility of transactions happening in cryptocurrency? And the sort of the obvious targets are going to be the centralized entities, exchanges that facilitate, crypto trading and activity. And probably B is, like you said, the blockchain itself. It's a public ledger, and so everything is visible. If they're able to detect that some transfer out of an exchange went to a wallet, and that that belongs to a certain person, and trace the sequence of events after that, that may be another sort of forum for them to look and try to find these inputs. And then you couple that with what they actually see in the tax report for a given person, what the person's net worth is, how much they filed every year, what the sort of the trajectory looks like. Um, I think there's quite a lot of inputs for them to not have a perfect system for auditing, but at least have these like significant heuristics to know that these sets of people are definitely worth auditing, and then having the process to actually dig into their data and potentially uncover like evasion or lack of compliance.
Mm. Yeah, yeah. How about on the other side of the coin? No pun intended. For individual consumers, have you seen things that are just like consistent? I wouldn't call them mistakes, but they're tax implications that if people knew, they would do things differently. One of the things that comes to mind is short-term versus long-term capital gains. If you trade
Mhm.
an equity, a stock, and you sell it in under a year versus sell it in over a year, the tax implications are much higher for short term than they are for long term. And this is the government trying to incentivize people to buy and invest in things long term. To me, it's kind of vague why that's even there in the first place, but it's there. Are there things like that you've seen where, whether it's dividends or some other mechanism where people are like at the end of the year, like, oh shit, I wish I had known that, I'm paying way more taxes than I would have had I done it this other way.
Yeah, there absolutely are major areas like that. I'll tell you three that I think are good examples of this. One is pretty basic. Let's say that you have Bitcoin from 2017. Today you want to buy Ethereum, um, and the choice of like what you're going to buy that Ethereum with is pretty significant. If you buy it with US dollars, there's zero tax implication of that buy. If you buy it by trading a Bitcoin from 2017, there's a large capital gain implication of that. Um, and so just being aware of that, it's a simple concept, but being aware of that and understanding that you have kind of an unrealized gain right now in Bitcoin. So if you were to do this transaction, you will have a major tax implication on it, is not obvious to especially the mainstream non-tech savvy, non-tax savvy population, and is really important for us to kind of help people understand as they make these day-to-day decisions on how they transact. So that's one. The second aspect is maybe going back to a similar example, which is, let's say you bought an asset like Ethereum. Um, I don't know. Maybe Ethereum is not. Maybe something that dropped a lot in value. So let's say you bought Ethereum like a year ago, and right now your Ethereum is at a loss. You have an unrealized loss on it. um, you could do nothing with it, but you do have the opportunity to sell that Ethereum, buy it back, and basically realize this capital loss, which you can then offset other gains you have, whether it's in crypto or even outside of crypto. So if you had a gain on, let's say, Tesla shares or some equity, and then you have this loss that you have realized by selling it and buying it back, you can offset it, reduce your taxes, and that's something that um, especially for the higher net worth, kind of more savvy individuals, can be an important mechanism as well.
Hmm.
Um, those are probably two good examples there. Um, I think there's a lot more. Like this is a kind of a big rabbit hole. There's a lot of things you can do to kind of optimize your taxes, especially if it's automated. Um, But I think these are kind of easy to understand, like examples of the implications of not thinking about taxes year round, and then kind of at the end of the year realizing that you've done something that led you to have a bad tax outcome, and you kind of wish you could go back and change it.
Was there a third one? I know you mentioned three. One. Nothing comes to mind, there's one that comes to mind for me, which I'm curious to hear your reaction on.
Yeah, what's the one that comes to your mind?
I'm thinking of if I say I had $10,000 in Bitcoin and I staked it, and then I borrowed money using like Nexo as a popular kind of centralized exchange. That they could send you a U.S. wire. You could take it out in any cryptocurrency, and then that's a loan. So then you can have that cash, you can pay rent, you can do whatever you want with it, and then you pay it back whenever you want on chain. I would imagine that's not a taxable event as far as income goes, because you're just taking out a loan, staking, and then paying back the loan. But you also would get access to capital similar to the effect of selling it. Um, is that one
Yeah,
that you've seen?
that's definitely an example as well. I think that one in particular is definitely like a more sophisticated strategy where you're, putting some of your Ethereum, putting some of your crypto assets to loan something in fiat. You are going to be taking a risk, of course, on that loan you're taking. If the asset goes down, that can be a significant risk. And so definitely something that, and for all of this, I would say, please speak to your tax professional. This is not advice
Yeah, yeah.
in any way. Um, but yeah, that's definitely another mechanism that folks can leverage in order to have a more favorable tax outcome.
Mm. How about you, John? I'm curious what gets you excited? What maybe motivates you to this day? How do you sort of, what future do you want to see in 10, 15, 20 years? Um, yeah, what gets you woken up every morning to work hard to build this? And yeah.
Um, it's largely actually the same thing that I was excited about like 5 years ago, which is the fundamentals of the potential of Bitcoin and crypto to be a superior, form of money, sound money that has much better fundamentals than fiat currencies do, um, where there is less of this misalignment of incentives with central banks and governments being able to generate a larger supply of it, causing all these sort of second order negative implications. Um, and so I'm really excited for a future where there's much more adoption of crypto as a store of value, as a medium of exchange, actually seeing people using it on a daily, weekly, ongoing basis, starting to transition more wealth towards cryptocurrency, and kind of everything being built on top of that. I think there are lots of interesting use cases even beyond that in the Web3 space, NFTs that are pretty exciting as well. But I think starting with the fundamentals of having this better form of money, building a financial system on top of that that's open, more equal to people around the world is what gets me motivated.
Yeah, essentially removing control of currency from government's hands and allowing it to be open, decentralized, and the impact of that affecting people across the world, particularly people that are most negatively impacted by inflation as we see today. Do you do a lot of playing around on the side, so to speak, like NFT reading papers, or are you more of the mindset like, hey, I'm just going to be heads down, coin tracker all day?
I definitely just explore on the side like everything that's
Mm-hmm.
happening, the latest and greatest. But I think when it comes to actually transacting and using kind of the meaningful portion of how I transact, it tends to be long term holding the sort of the core assets I believe in. Um, and trying to build for that future where there's less of a hurdle for the mainstream population to actually use this new technology. Um, we get to uncover a lot of the value propositions that are pretty inaccessible to a lot of people right now. Um, hurdles like tax is one, but even in the usability of crypto, like especially as you go beyond one exchange and into self custody, into trying to use this day to day, into actually it being available in the physical world, the digital world, as a way to pay for goods and services. I think those are the places that really interest me first and foremost, and where I spend sort of more of my time in.
And I assume you mean by the core holdings like Bitcoin, Ethereum, some of the larger projects that are out there.
Yeah, that's right. I think Bitcoin is big, of course, as a store of value. Um, it's kind of got the network effects over a long time. Um, I think the layer two, of either Bitcoin or of other chain is pretty interesting as well, especially to solve the scalability challenges. Um, but yeah, Ethereum presents a lot of interesting opportunities as well. So those are the sort of core assets that I largely have a long term bullish view on.
Mm. Are there people or books that you've learned from exceptionally that you wanted to throw out there?
Yeah, I read a lot, and definitely have learned a lot from many different books. I think one major category that resonates with me the most, that I get the most out of, are biographies and stories of real companies. So biographies like even kind of older school, like Einstein, Da Vinci, um, and then more a bit more modern, like Founders at Work by Jessica Livingston from Y Combinator, that talks about a lot of founding stories of tech companies. um, Steve Jobs, upstarts, Alibaba, all of these stories have every story I think has really interesting tidbits, both positive and things not to repeat. And I get a lot out of those. I think secondly, on the business sort of books, I would say that for the most part, almost every major area that I have encountered in starting a company, building a product, like scaling a company, every aspect of that, whether it's hiring, whatever it is, there's probably a great book for it. So I would just seek that out and talk to other people to learn of those. And it's a way to take a shortcut towards where you're going. And then I think the third thing I'd mention is um, for us, Y Combinator has been a key part of our journey as well. Both being in the program, the alumni community, the partners and advisors there, but also the content they create. They've created a wealth of content that's actually available, not just if you're a YC company, but to anyone out there, and have basically written the wisdom on how to start a company, how to build a product people love, how to kind of use your skill set to a positive impact. And so I definitely highly recommend like studying that. It's very high ROI type of material. I think ultimately the outlier success stories are so rare. I feel like it's really worth studying how they came to be and what took place there, what those individuals or companies did really well, and I think you get to learn a lot from that.
I'm so curious. I want to ask you about that. What do you feel like are certainly there's a degree of luck that is undeniable. When you start a company, a lot of people have aspirations to be a really large company, but it really matters what initial problem you solve and then series of subsequent decisions you make along the way of building out product and culture, etc. Are there things that stand out to you when you think about the company you're building or just in your head that come to mind when you think about the things that have made large successful companies, the exceptional ones, as differentiated from all the rest?
Yeah, this is probably something I actually kind of think that's not super common, which is like I think it's tempting for new companies like startups to move as quickly as possible in every dimension. I think that's probably in many cases an error, um, because some of those decisions you make in the early days are not reversible. They play out over a long time, and they're not. You can't really change that. So an example like that is the culture you build. Um, Culture is something that forms one way or another. Um, and if you're not intentional about forming it and kind of deciding like what kind of culture do you want to build, it will still get formed, but you might not like it and you might not be able to change it. And so I think when I look at a lot of the great successful companies that have stood the test of time, they were very intentional about the culture they're building, the values, the guiding principles that are important for them. And from a very early stage, they hired around them. They kind of they recognized great behavior around them. They addressed poor behavior that didn't resonate with those values, and I think it was just a very intentional process and leads to very positive long term sort of success stories in many cases.
Mm.
Um, I think the way you hire is another one. In the early days, you have so much to do. You just want to move as quickly as possible. In our case, we actually took 2 years to hire our first 15 or so people. And then we went from about 15 to 80 in like a year after that. And I think, again, that people that you bring in, especially that early on, are going to have such a significant impact on everyone else that you hire later on, and the culture you form, and the types of problems you'll be able to take on, that it's really important to get those initial hires right and not move too fast on that particular dimension.
Yeah, yeah. People are culture, and vice versa. John, this is a lot of fun. Thanks so much. I appreciate your time today. And are you active on Twitter? I think your name Jon Jon_Lerner. Anywhere else you want to throw out that you're personally writing? We'll have links to CoinTracker in the show notes.
Yeah, no, I think my Twitter is the perfect place.
Cool.
And yeah, it was a lot of fun. Thanks for having me, Mike.
Yeah. Thanks, John. See ya.
See ya.